Baby. FedEx, my bad, you know what, apparently did pretty well today. Welcome back, everybody. We're going to do a quick analysis of FedEx stock, and I really want to rhyme it with something else, but I think I would get in trouble, so I'm going to refrain from doing that. Now, we all know what FedEx is, okay? You want to mail something, you go to FedEx, or you go to UPS, or you go to USPS, or whatever. You want to get something from one place to the other, a letter, whatever you want to send to your weird friends. You go to the post office and you mail it, okay? Now, the stock has recently skyrocketed after earnings because they have raised their earnings forecast. Remember, ladies and gentlemen, investing is all about the future, which, in my opinion, is unknowable. So when a company raises their earnings forecast, and it changes the market's expectations of what the stock and company is going to do, it usually has a positive impact on the stock price. Imagine if you owned an investment and the CEO told you last year, hey, Chris, hey, man, hey, Bobby, whatever your clownish name is, you're going to make $10 next year from this investment. We're going to give you $10. And then the CEO comes back and says, hey, we're actually going to make $15 for you next year. What would you do? You'd be like, wow, I'm making $5 more. This investment is probably, this company, whatever I own, is probably worth more. Same effect usually with the stock market, but of course it fluctuates, okay? So they hike their earnings forecast, and they have a cost-cutting measure, okay? Because there's apparently some demand issues going on, as we're going to see in a second. Now, overall, FedEx is flat for the year, and over the past 5 years, it's down 11%. So overall performance has been kind of turdish, shall I say. But people get excited because the stock went up 8% today. But if you actually look at the historical performance, which, like I said, is not necessarily indicative of future performance, it really hasn't done that well, okay? And there's a reason why the stock price really hasn't exploded. And if you go look at the financial statements, you'll see it. So what I like to do is I like to look at the actual balance sheet, income statement of cash flows. But I also like to look at kind of like the aggregate, how the company has done over the past couple of years, because you can really see what's going on. So if we look at the revenue of FedEx, we can see that the revenues massively exploded over the last couple of years. So it looks like this company did pretty well in 2021 and 2022. And they really didn't do that bad in 2020, which kind of makes sense because even though everybody was locked down, everybody would still mail stuff. I would actually argue that if you're locked down, that would probably lead to more stuff getting mailed back and forth because people aren't going to the stores as much. So the pandemic didn't really hurt them that bad, at least from a revenue perspective. And in 2021 and 2022, their revenue has absolutely exploded, which is a good thing. You want revenue growth, okay? So it doesn't seem like revenue, at least recently, is a problem. You look at the quarterly, though, we could see that revenue over the last couple of quarters has actually started to trend down a little bit. It doesn't seem to be the death of the company, but that's something to keep in mind. You always want to look at the annual, and then you want to look at the quarterly, because even though the annual revenue year over year might be up, there might be some catastrophic decline in revenue for some companies that you don't see unless you look at the quarterlies or annuals, okay? Let's look at some profit margins. I like to look at profit margins. So we can see they have a gross margin in the 60s. Now, over time, let's make sure we're looking at the annual. Over time, their gross margin has started to go down. It's trended down a little bit. It's not catastrophic, but for a company like this that I can see has very low operating margins, you want to have as high a gross margin as possible, okay? But gross margin has trended down. Operating profit has kind of stayed stable, okay? So even though their gross margin has gone down, they've been able to control their operating expenses. So when you're looking at this company, you definitely want to pay attention to how much they're spending on operations, because with gross profit going down, if you keep your operating expenses as the same percentage, you're going to start becoming unprofitable every single quarter. So I can see why they're doing a cost-cutting initiative, because their margins are going down, okay? Profit margin, it looks like it's in the low 4s, 5, 6, okay? So it's not a very profitable business from the accrual basis of accounting. That doesn't mean it's not worth anything, okay? Everything has a value except for you, but it's not the most profitable thing in the world. And what happens is businesses that aren't super profitable, They have one little issue with costs, and suddenly they're unprofitable, okay? Free cash flow margin ain't that great, all right? But a lot of times they have negative free cash flow. That doesn't necessarily mean a bad thing. They could just be doing a lot of investments into future projects, because free cash flow, you take operating cash flow minus investing cash flow, specifically for property, plant, and equipment. So maybe they're just doing a lot of investments, but you can see the actual free cash flow that they can use to buy and sell, buy back shares, pay dividends, pay off debt, et cetera, has gone down. Now, let's look at the balance sheet. So they actually have uploaded the most recent balance sheet, which is shocking. Let me make sure that they actually did that. Yeah, they already have the balance sheet information here in stock analysis. Good for you, stock analysis. So when I look at a balance sheet, I always want to compare current assets to current liabilities to see if the company's imminently going to go bankrupt. A current asset is something that can be or will be converted into cash within a year. For example, you have cash, which is already cash, receivables, inventory, and other current assets, whatever that is. So their total current assets are almost $18 billion, which is a lot. You compare that to current liabilities, 13.5. Okay, they're probably not going to go bankrupt anytime soon. Long-term assets, 67 versus long-term liabilities of 47. So they actually have some, or you as an investor actually have some equity in some of the property, plant, and equipment, which is a good thing. I like to make sure that companies that have long-term assets aren't underwater on those long-term assets. It's kind of like having a house that you buy and your mortgage is higher than the price that you paid for your house. That's basically kind of what would be the issue if you saw that you had more long-term liabilities than long-term assets. Another thing I like is that we can see this is a very capital-intensive business, number one. Look at their property, plant, and equipment. Property, plant, and equipment is, 70% something of total assets? So this company's going to have a lot of depreciation. That's all I'm going to say right there. But at least a lot of their long-term assets are not intangible assets. There are some companies that have a lot of goodwill and intangibles as the vast majority of their assets. And to me, that can be terrifying, because if a company has an impairment with their goodwill because they bought a stupid company, which seems to be the case for a lot of companies, that can lead to some absolute destruction. Okay, so in my opinion, tangible assets are usually more preferable when I'm looking at a balance sheet. If I see a lot of goodwill, it's like, wow, that's terrifying. Okay, so overall, I mean, from a balance sheet perspective, they're doing just fine. Okay, we could see common stock is negative. That's interesting. Let's go look at their 10Q. Let's go see what they're actually doing with their equity. Sometimes the reports are confusing. So when we look at their equity account, okay, we can see they have common stock. Now, when you're looking at common stock and additional paid-in capital, people always get confused by this. It's a very simple process. A company, from an accounting perspective, puts common stock on their balance sheet at par value. So FedEx's par value for a share of common stock is 10 cents. 10 cents. So for every share they give out, they issue a share, they're going to credit par value, 10 or common stock for 10 cents. And then whatever the share was actually given out for, all the difference goes to additional paid-in capital. That's basically it. So if you add up additional paid-in capital and common stock, that's all the shares that they've issued, basically the cash they've received for all the shares that they've issued. Par value is just a weird, I don't even know why it exists. I don't know why it exists. It does. There's some reason, but I forgot. But it's like basically doesn't matter. So don't worry about it. Retained earnings. Okay, so retained earnings is the company's accumulated profit and loss has gone up. So we can see they've been pretty profitable the last year. Accumulated other comprehensive loss. What could that be? And treasury stock at cost. So treasury stock is when a company buys back stock. So they've been doing a lot of stock buybacks. Okay, they've spent almost $18 or $12 billion of buybacks. Okay, so they're trying to give returns to the investors by buying back the stock. That's a lot. Okay, now this accumulated other comprehensive loss. When you see that, it's usually foreign currency. It's usually it could be pensions, which I believe they have a small pension system, which they're thankfully getting rid of. Which, from an investor's perspective, at least, it's derivative cash flow hedges. and it's something else. But basically, there's a couple things. This is important. You always want to check accumulated other comprehensive loss, because there's some things that don't hit the income statement. They go to the statement of comprehensive income. So when you see earnings per share, all the changes in here, we can see they had a $200 million change, a decrease in accumulated other comprehensive loss. That difference is not going to show up on earnings per share. But if a company's getting absolutely wrecked, like Silicon Valley Bank, for example, and you don't look at accumulated other comprehensive loss, you just look at earnings per share, you're going to miss some big yields, okay? Like a massive decline in bond values. Just saying, okay? So with FedEx, it's mostly, I believe, pensions. Pension my, you know what, tension. So they have a small pension system. Okay, changes in investment. What the heck is it? Let's see. Oh, here it is. Foreign currency translation adjustments for the 3 months and amortization of prior service credit net of tax benefit and blah, blah, blah. Okay, that's pensions. Okay. Pension accounting? No, I'm not going there. That was the hardest thing I did. It's a huge pain. If you're good at pension accounting, you're a freaking hero, okay? But it's in my opinion, it's tough stuff. So basically, it looks like most of the change in comprehensive or accumulated other comprehensive income was due to foreign currency, not pension. But they do have a pension. So I would be concerned if a company had a very large pension system, because with pensions, it's like most of the clowns that design these pensions, their assumptions about the future earnings of the pensions were usually massively inflated. And so they promised, in most cases, people that retired at usually young ages, a lot of money in retirement. Oh, we're going to pay you $20,000 a month there, postman. And that just leads to problems, because that's a liability of the company. So at some point, if they screwed up their pensions, they're going to owe a lot of money to future people. So that could potentially be a problem for a lot of companies with large pension systems. But here they could say, here it says they got rid of their pension system, which is good in my opinion as an investor. Okay. Well, I'm not an investor, but you know what I mean. So let's look at operating cash flow. So they have very healthy operating cash flow. Okay. Very, very, very healthy operating cash flow. But a lot of it is consumed by capital expenditures. Okay. Obviously, it's FedEx. I need vans and storage facilities and all sorts of crap. So you're not going to see high levels of free cash flow in this kind of business. And you can also see the massive add backs to depreciation and amortization. Depreciation and amortization was $1 billion in the last quarter. $1 billion in a quarter. Okay. You look at it annually, almost $4 billion of depreciation and amortization. That's basically the only add back it looks like on the statement, or the main add back on the statement of cash flows, which makes sense. Okay. Looks like they're divesting a little bit of businesses, and they're paying a dividend. So their dividend has actually gone up, and they've done some share repurchases. Okay. So you can see it looks like they issue some shares that could be stock options, and then they have huge buybacks of shares. So they have a pretty hefty buyback program. Now we go back and look at their cash. I mean, I guess they have, let's see, current assets, current liabilities. I mean, I guess they could maybe do more buybacks, but their current assets are starting to trend down over the quarters. So I don't know if the buybacks are going to slow down a little bit, because you don't want to spend all your cash just buying back, bro. You don't want to do that, because you deplete your cash. But I mean, they're still capable of buying back stock. It just may decrease a little bit unless they can pump up their cash balance. So overall, what do I think about this business? Well, I compare it to UPS, right? Which is another big daddy. So they have different accounting for their gross margin. I wouldn't even compare that. But you could see their profit margin for UPS is so much higher, okay? And their free cash flow margin is much, much better. So from a profitability standpoint, UPS seems to be doing better. They still have solid revenue growth. Okay. Let's go back. Let's compare revenue. FedEx also has, decent revenue growth. So they're both revenue growers, and you can make money on both stocks, right? But me, I'm more comfortable with the business that is more profitable, because if something goes wrong in a quarter, at least it's still going to make you money. Okay. But that doesn't mean that one is overvalued and one's undervalued. It's all about the price you pay for the future earnings of the company. So from an income statement standpoint, maybe I'll do a separate video on UPS, but at least from an income statement standpoint, I'm a little bit more of a fan. Maybe the balance sheet will say something different though. Okay. So overall, are you going to buy FedEx stock? Am I going to buy FedEx stock? No, I'm not. Just kind of my thoughts. All right. I'm here. You can start, man. Welcome, Tom. I got to make this quick. I got things to do. What are your thoughts on FRC? I'll look at it. It'll be interesting to see their bond portfolio, if they have one. Look at Google. What's wrong with Google? What happened to Google? Did it go bankrupt? Okay, one day. Oh, yeah, okay, I'm looking at Alphabet stock. It's like typical changes. Oh, you want me to just, okay, I'm a moron. It's early. You want me to just look at Google. Got it. Tattooed Chef going below $1. How are you going to celebrate it? I don't know. I got to think about that one, ladies and gentlemen. We'll see. Lefebvre making like 100K now from Patreon. The grifters have defeated us, boys. We're done. We're done. Time to join them. Deep dive analysis on FUV and Hippo insurance. Oh, there's no deep dive for those stocks. They're clown stocks. When are you going to put your wife's cool hat on again? I don't know, when the sun comes out. Hey, my silver shot up. I have my coins laying on my bed, the silver coins. Gold shot up $70 on St. Patrick's Day. That's actually a proven fact that gold always goes up on St. Patrick's Day. Let's see. Imagine if Vanguard went under. I don't know. Vanguard Fund safe. Woo! All right, guys. So that was my brief overview of FedEx. I mean, okay, wow, they raised their forecast. Okay, buy the stock now. I don't know. To me personally, I think UPS would be something I'd be more interested in looking at in more detail than FedEx. But I'm not saying FedEx is a bad business. It's just not the most impressive thing in the world. All right, talk to you later. Cheers.